To avoid this trap, consider adopting a strategy known as dollar cost averaging. This approach involves investing a fixed amount of money at regular intervals, regardless of market conditions. It's a straightforward yet effective method that removes emotion from investing and fosters discipline. Think of dollar cost averaging like growing a garden. Instead of planting all your seeds in one go and hoping for the perfect weather, you plant a few seeds every week. Some weeks are stormy, some are sunny, but overall, your garden grows steadily. You're not trying to predict the perfect day for planting. You're nurturing consistent growth over time. The same principle applies to investing. Instead of trying to time the market or placing all your bets on one speculative stock, you consistently invest in a diversified portfolio over time. This method reduces the risk of making a substantial investment right before a market downturn, and it helps lower your average cost per share, smoothing out the market's volatility. To illustrate how this strategy can work, let's look at a real-world example: Warren Buffett's investments in Coca-Cola. In 1988, Buffett began buying shares of Coca-Cola, a well-established company with a proven business model, strong brand, and consistent earnings. At the time, many thought he was paying a premium price for the stock, but Buffett wasn't concerned with short-term price movements. Instead, he applied a value-driven long-term investment strategy, gradually accumulating shares over time. By regularly purchasing shares of Coca-Cola, Buffett utilized a form of dollar-cost averaging. He wasn't trying to time the perfect entry or exit point. He was confident in the company's long-term fundamentals. Over the decades, as Coca-Cola continued to grow and generate steady returns, the value of Buffett's investment soared. What started as a $1 billion investment is now worth over $25 billion, not including the substantial dividends Berkshire Hathaway has received over the years. Now, to take this a step further, consider combining dollar cost averaging with value investing. Instead of just spreading your investments across the market at regular intervals, focus on investing in undervalued, high-quality stocks. Value investing means looking for companies with solid fundamentals that the market has overlooked or undervalued, like finding a diamond in the rough. Let's consider Johnson & Johnson, J&J, as a prime example of a strong value-driven investment strategy, especially when compared to the broader market, like the S&P 500 index. In the aftermath of the 2008 financial crisis, J&J presented itself as a company with a robust balance sheet, diversified product lines across pharmaceuticals, consumer goods, and medical devices, and a proven history of steady growth. Despite market turmoil, J&J was viewed by many as undervalued due to temporary fear and uncertainty.